Yes, so today, Emily, we are going to start with a quick discussion of the exam pattern. Then we're going to revise a little bit of what we did in the last class, the trial class. We'll get into more detail, of course, this time. We have discussed the double entry system, and we'll also discuss the treatment of things, to which we'll try to get into ledgers and D accounts, and then if we find the time, we'll get into receivables and payables. All right. So exam pattern. Emily, do you have any idea about the exam pattern for AS level accounting?
No.
Okay, good. So we'll start with that. So the duration. Okay, Emily, one thing. Do you take notes?
Yes, sir.
Yeah, so that would be very, very paramount for this, that you do take notes and you go through them once the class is finished. That's one. And the other thing is practice. Obviously, we cannot do all the activities in the book within the class, but I would expect you to do them in your own time, and then you can let me know whenever you get in trouble. And when it comes to, we'll do a lot of practice in class as well, but that would mostly be from full-fledged questions or past paper questions. But the book activities you need to do on your own, and you can let me know whenever you get stuck anywhere. All right. So, all right. So the duration for the accounting AS level exam, extended exam, is 3 hours. And the total marks are 200. You basically will get two separate documents when you show up in the exam hall. The first one would be your question booklet. And the second one would be your resource booklet. So this resource booklet, you will have the data for the questions. In the next class, I'll try to show you an exam paper so that you get some better idea. So basically, the resource book in the question booklet, you will have to write your answers, and the questions will be written on the questions booklet itself. Whereas the data required to solve those questions, you will find that data in your resource booklet. Is that clear?
Yeah.
And so basically, the pattern would be something like in the question booklet, because the resource booklet, it'll just be written words. In the question booklet, you will have a question, and then you will have some empty space underneath the questions where you will have to do all your working and show them the answer. So this would be the pattern. Now let's talk about the content that you get in the exam. Your exam is divided into two separate parts. You have a section A, and you have a section B. In section A, you will get, you will get two compulsory questions of 55 marks each. Now you will have no choice in this section. You will have to solve each and everything. And One other important thing is that the 55 mark questions will be divided into several parts. So these questions will have parts. And when it comes to section B, you will get 4 total questions of 30 marks each. And you'll have to attempt any 3. So over in section B, you do get a choice to skip 1 question. Okay, so this is basically your exam pattern. Do you have any questions regarding this? Please let me know.
No.
Okay, good. Now let's talk about the content of the syllabus. All right, so your syllabus is basically accounting in itself is divided into 2 major branches. Well, in fact, 1 major and 1 minor branch would be a better way to bifurcate these. The first branch is financial accounting, and the other branch is it can be called 2 things. Firstly, it can be called either cost accounting, or it can be called managerial accounting. These are one and the same. All right, so from financial accounting, which includes everything from let's say recording of transaction up until the creation of financial statements. So all of this is approximately 80% of our syllabus and also in general, when it comes to accounting, 80% is covered by financial accounting, and cost accounting comprises of around 20%. And what we do here, as the name suggests, is basically there are different ways to assign cost to your products and analyze and cost items using different methods. So there are 3 or 4 methods. You learn them, it's only in this syllabus especially. When you learn them, you're done with cost accounting. So this is the part of the syllabus which we will touch upon in the end. We'll start with financial accounting. Now, is that clear?
Yes.
Okay, great. Now we'll try to revise some of the important concepts which we did in the trial class, because those are foundational. So, all right. Let's talk about the main 5 main categories. In fact, let's do all 6. All right. Do you remember from last class what they are?
Yeah. There's assets, liabilities, capital, expenses, I think revenue, and I don't remember the 6th one.
All right, we'll do them all again. Emily, just one little thing. Your voice gets really muffled when you talk. Especially when you talk in long sentences, it's very hard to hear you.
Can you hear me now?
Yeah, it's much better now.
Okay.
Okay, cool. Okay, so you are absolutely right. We have, and the first thing we have assets, then we have liabilities, then we have capital. This can also be called equity. If you ever come across it, don't get confused. It's basically just capital. Then you have expenses, then we have incomes, and finally we have dividends or drawings, right? Okay, so let's start with assets. So assets are anything which the business owns, anything owned by the business which may generate future economic benefit. So anything that the business owns which may bring some sort of, for example, a future economic benefit. For example, if the company owns a building, they can give it out on rent and they can receive rent. So as the building will generate rent, which is an economic benefit, that will be called an asset. If, for example, uh, you run a restaurant and you bought two vehicles for delivery purposes, for home delivery purposes, in that case, those delivery vehicles, you may charge delivery charges to your customers. So those vehicles are bringing in some sort of income for the business. That income is basically your economic benefit, which means the vehicles are your asset. Are we clear with assets?
Yes, sir.
Very good. Vehicles, let's say equipment, etc. All right. Now liabilities. Liabilities, as the name suggests, are obligations which the business needs to pay off. Now, these can be, businesses can take bank loans, or one of the most major liabilities which we will come across again and again are accounts payables. Any idea what account payables are?
It's like for the business, it's like the suppliers to them.
Right, right. So whenever we are buying from our suppliers, we can buy using either cash, for example, right? You can go to them and you can tell them, okay, I need this much stuff and I'll pay you right away. So there is no credit involved there. There is no payables involved there. However, if you go to them and tell them, all right, just give me all this stuff and I'll pay you back in 10 days or 15 days or even like 3 days from now. I cannot pay you right now. I won't pay you right now, or whatever the case may be. You're not paying them at that moment in time. In that case, instead of cash, you are actually buying on credit, and that is a situation where accounts payable arise. We'll talk about them later, but as you have to pay them back eventually, as you have to pay your suppliers back eventually, account payable would become a liability. All right.
Okay.
Good. And the third thing is capital or equity, which is just basically the investment into the business by the owners. Expenses are just expenditures. Incomes are okay. So let's do a few examples. Expenditures can be, for example, if you don't own your building and you have your factory or building or whatever your office space, you've rented it, so you will have a rent expense. If you have some employees, you will have salary expenses. If you have, obviously, you will have some electricity in the building that you have your office in or your factory is running. So you will have utilities, these sorts of expenses. Incomes are obviously, I'll just write incomes again because they are your incomes. And incomes can be, for example, one of the most major income which almost every business will have is your sales revenue. Sales revenue is an income. Uh, Another income could be, for example, the bank had some extra money put in their account which they never used, so they invested that money into the market and they get return on that. That sort of income is called interest income. And there could be some other incomes like whenever you sell any of your non-current assets. uh, don't get confused by the semantics, but when you sell your assets like buildings or vehicles and you sell them on a profit, you sell them at a greater value than they hold at that point in time, you record an income. But it's too early to get into all that. You just need to know what incomes are. Okay, dividends. All right. Any confusion?
No, sir.
Okay, good. Okay, dividends and drawings, I've written them together because their treatment is the same in accounting. All right. When it is, do you know what a sole trader is or a partnership, or do you have idea about types of businesses?
Yeah, I do.
Good. So whenever we're talking about sole traders or basically small businesses owned by just one person, so whenever they take stuff out of the business, the stuff could be in the form of their stock or inventory, or that could be in the form of cash as well. So those are basically drawings. And whenever the companies, when we talk about companies and they make profits, they pay some of that profit back to their owners who are their shareholders. So that's basically a dividend. In fact, I'll just write it as well. Just give me 1 second. All right. So, so let's start here. Drawings. Drawings are basically money, amount of money or any asset which the owner takes out of the business for their personal use. This personal use phrase is very important. They take out money for their personal or their family's use. That are drawings. For example, if they sort of run a basic, let's say, journal store, maybe even, and they have got breads and eggs and stuff like that, and they take some of them home for their own personal use. In that case, those will be recorded as drawings. And when it comes to dividends, dividends are percentage of profits which are shared with the shareholders, which are basically the owners. Are we clear, Emily? Any confusion in this, in any of this?
No, sir.
Okay, good. So one last thing before we actually move on to doing good, proper examples. Okay. Although I think we also did this in the first class, but this is very important, so we have to go through this again. which is the, okay, in fact, let's do a couple other things as well before we start with our examples because we have time. So we've just read, we have assets, liabilities, capital, expenses, incomes, and let's just call them drawings for now, only because we're going to focus on sole traders. When we get to companies, we can think about dividends. All right. So, Emily, one thing before this, any idea what the double entry system is?
It's just like for every transaction, there's like 2 entries.
Okay, that's very good, but that's just one part of it. Any other idea?
Both entries have to be opposites. Like the one has to be debit, the other one has to be credit.
Okay, okay, all right. Any other thing?
No.
Okay, all right, all right. So you are absolutely right. Every transaction, every transaction must, so this is a must have, and one thing which you forgot in your definition is at least. Must have at least 2 effects. Now they can be more than 2, all right, but at least there have to be 2 effects. And number 2 is there should be both debit and credit. This is the second part, and the most important, every one of these is important, but another very, very important thing is that the debit side must always equal the credit side. So these are the 3 main components of the double entry system. Now these words, debit and credit. Okay, often students get a lot of confusion in this, but that confusion doesn't make any sense. I don't know if we went through this in the last class, but debit is just left and credit is just right. So you can think of it like this, that right, so this is how you direct people towards a certain direction in English language. All right, in French it would be something different, in Italian it would be something different. This is how you direct people in the accounting language. All right, there is nothing more to this. Is this clear? Any confusion regarding these words?
No.
Good. And now we can get into our table. Yeah, this one. Okay. All right. So always keep these, if you have these in your mind, then you will never have any issue with any transaction that you come across. As long as you understand what is happening, you will be able to do the 100% right treatment to it. All right. So assets, whenever assets are increasing, we are going to write them on the debit side. Otherwise, we're going to write them on the credit side. For liabilities, it is the opposite. Whenever liabilities are increasing, we write them on the debit side. Oh, sorry, on the credit side. And when they are decreasing, we write them on the debit side. For capital, they follow the same rule as liabilities. For expenses, they follow the same rule as assets. For incomes, it's the same as liabilities and equity or capital. And for drawings, it's the same as assets and expenses. Right, so this is a very, very, very important chart. That what we can do is we can right. So this is an extremely important chart, and the crux of it is that assets, expenses, and drawings have a debit nature. So Emily, nature of any category of account means that where do we write it when it increases? All right, so any asset account will have a debit nature because whenever it increases, we write it on the debit side. Any liability, any income, any capital account will have a credit nature because whenever these things increase, we put them on the credit side. Is that okay? Do you get that?
Yeah, I get it.
Okay, so assets, expenses, and drawings and drawings have a debit nature. This is called nature, and the remaining three, which are liabilities, capital, and incomes, have a credit nature. All right.
Yeah.
Good. Good. Now you may ask, what is the logic behind all of this? And even though I don't touch upon this up until we are through the financial statements, because once we're done, which takes around 12 to 15 classes, once we're done with financial statements, then we can actually, the student gets a holistic view of what is actually happening. But I'll just give you a very, very quick reason why this is the way it is, why these three things are being debited or why these other three things are being credited. And hopefully you will be able to link it as we go on further. I won't get into much detail of this, but you may have heard of the statement called the accounting equation. Do you have any idea what the accounting equation is?
Yeah, it's assets is equal to liabilities plus capital.
Yes, absolutely. Assets equals liabilities plus capital. All right. So, Emily, there are two sides to this. Assets is written on what side of this equation?
On the debit side.
On the debit or the left side. That's absolutely correct. And liabilities and capital are written on the credit side of this equation, right? So this is what is telling you about the nature of these accounts. That assets accounts have a debit nature and liabilities and capital account have a credit nature. So now we'll get into the confusing part, and I'll just do it very, very quickly, just so that I can explain to you why incomes and expenses are treated the way they are treated. All right. So when we talk about capital, capital is divided into two main things. We'll get into all of this later on in this syllabus. So especially when we're talking about companies, Emily, we have the ordinary share capital. That's one thing. And the other thing that we have underneath capital are the retained earnings. And underneath these retained earnings, we have three things. We have, how do we get retained earnings actually? We take our revenues, we subtract our expenses from those revenues, and then we subtract our drawings from those revenues. All right. So forget these two things. You all only need to know that revenues, how do we get retained earnings? We take revenues or our incomes, our total incomes. We subtract our expenses from those incomes, and then we subtract our drawings, and then we get retained earnings. Is this clear? A little bit?
Yes, sir.
I just want to give you a holistic view. That's it. So don't get confused.
Okay.
Okay. So now, Emily, when we look at this word, liabilities, we know it has a credit nature. When we look at this capital word, we know it has a credit nature. So if this capital has a credit nature, this means this ordinary share capital will also have a credit nature. All right. This retained earnings account will also have a credit nature. Okay, so things are pretty straightforward when it comes to retained until this level. But when it comes to this level, we look at revenues and we see if there is no sign with revenues, which that means there is a positive sign with revenues. So which is why revenue will follow the credit side of things. However, if we look at expenses and drawings, they have a negative sign. If we move these two things up onto this asset side, they will both become positive. Right? Does that make sense? So this is the reason why expenses and drawings will always have a debit nature and not a credit nature, and everything other than those things and assets obviously will have a credit nature. Does this make sense?
Yes, sir.
Okay, perfect. It's very important for you to think like an accountant, and if you have to think like an accountant, it's very important that you understand the logic behind whatever it is that you're doing. All right. So now we'll get into a few examples of, okay, and one last thing before we get into the example. I think, yeah, we did discuss this in the last class as well. So steps in accounting. So what it is exactly that we do in accounting? The first step is that we record the transactions. Once we have recorded the transactions, we make ledgers, or they can also be called T accounts. Ledgers and T accounts is one and the same. Once that is done, we make the trial balance. And once that is done, we get to the financial statements. All right. Now this step is almost 60 to 70% of accounting, of financial accounting, and if you've done this correctly, then the chances that your financial statements will be correct are extremely high. Because once you've done this, these next two steps are basically just formatting steps. Obviously, there are a few rules which we need to follow. There are a few other things which we will learn, but essentially they are just formatting steps. The main thing is that you record the transactions properly. And how do we record the transactions? We record them by doing general entries. Journal entries, and that is what we will do practice today. Are we clear so far?
Yes, sir.
Okay, so now let's start some practice. So for example, you get an entry or a statement written in front of you which says that on January 5th, 2023, XYZ Corp bought let's say vehicle for around 10 grand, 10,000 in cash. All right, so you get this. Now, when we read this statement, how do we make journal entries? It's very simple. Just write it here as well. Wait. In order to make a journal entry, the first thing that we need to do is whatever is being debited, we write it at the top, right? So, for example, any account, we'll write debit, whatever the account is, account A, we'll write the amount in front of it, and the credit thing will be written underneath, and a little bit of space will be left. You will write credit account B, and you'll write the amount over here. And we have to be 100% certain that these two accounts are always equal. All right, so this is how we basically record a journal entry. Okay, good. Now, so this is the transaction on this particular date. Okay, and one other thing, it's a good rule of thumb to practice it, to follow this right when we're starting, is that you always write the date first on the very left. So you'll write January 5th, 23, and then you'll write the debit thing here and the credit thing here. All right. Okay. Now, on this particular date, they're telling us that we bought a vehicle for $10,000 in cash. All right. So what accounts, Emily, do you think are being affected by this transaction?
Vehicle account and cash account.
Absolutely. So this is the first step that you need to take. You need to understand, okay, what accounts are we dealing with? So you were absolutely right in pointing out, so there is vehicle account and a cash account that is being affected. Now, what is happening to the vehicle account? This is the second step. What is happening to the vehicle account? Is it going up or is it going down?
It's going up.
It's going up, absolutely. And what about the cash account?
It's going down.
Absolutely. So that's the second step. The first step, you identify the accounts. The second step, you figure out what change is happening, if anything is going up or if anything is going down. The third step is you categorize these accounts. Where do you think out of the categories of asset, liabilities, capital, expenses, income, or drawings would a vehicle account come?
Asset.
Asset, absolutely right, because it will bring us future economic benefit. And what about the cash account? What category is the cash account?
Also asset.
It's an asset because the cash can be invested into the market to get some returns, because the cash, we can use the cash to, for example, go and buy more inventory, which we can then sell for profits. So obviously cash is an asset. Absolutely right. Now you have taken all the information you needed to in order for you to make the journal entry. An asset is increasing. The name of the asset is vehicle. So whenever an asset increases, we write it on the
debit side.
Debit side. So we'll write vehicle account, debit, vehicle account by £10,000, and cash is an asset decreasing. The name of that asset is cash. So we will write credit cash account £10,000. Does this make sense?
Is it compulsory to write debit and credit at the start?
I'm sorry.
Like in the when you're recording the journal entries, do you have to write debit and credit at the start?
This is only for your understanding.
Okay.
The reason I'm writing it right now, but we don't need to write it.
Okay.
That's not important. But if you write it, no marks are going to be deducted, but it just wastes time, so you don't actually need to write it.
Okay, sir.
Yeah, but just so we understand the pattern and all that, I'm writing it right now.
Okay.
Okay, good. Okay. Now let's do a few more examples. Number 2 would be, okay, so let's say we paid rent in cash in dollars, 5,000 or pounds, 5,000. Right. So now, Emily, again, the first step is identifying the accounts. What accounts do you think are affected by this transaction?
Rent and cash.
Rent and cash. Absolutely. So what is happening to either of these accounts? What's going up? What's going down?
Rent is going up, cash is going down.
Okay, now what is cash as we discussed in the previous?
It's an asset.
It is an asset. And what about rent? What is rent?
An expense.
An expense. Absolutely. Perfect. Now, okay, so now let's just record the journal entry. Rent, which is an expense is going up. So we will debit the rent account by 5,000. Cash, an asset, going down. So we will credit. It's a good practice to write this in front of your double entries whenever you're doing the entries. Cash account and rent account. So that's 5,000. Is this clear?
Yes, sir.
Good. Now let's do another example of an income. Let's say that we received interest income. In cash, pound 750. Now, Emily, you tell me what would be the entry for this.
It will be interest account debit 750 and cash account credit. No, sorry. Cash account debit 750 and interest income credit 750.
Absolutely right. And could you provide me the logic why you've done it like that?
Because cash account is increasing and assets are when they increase they go on the debit side. And interest income is an income account, so when it increases, it goes on the credit side.
Absolutely. Absolutely. All right. Okay, good. Now let's do a few things, a few entries which are a little bit on a different side. Let's say you get an entry saying, all right, sold goods amounting to pound, let's say 3,000, again in cash. Give this one a try, Emily. Tell me what would we be doing here.
Will it be sales and cash accounts affected?
Yeah, cash and sorry, which one?
And sales?
And sales. Absolutely. Okay, and also what general entry would we post?
Sales of wait.
I'm sorry, I didn't quite catch you.
So sales account is increasing, I think. So you
Yes,
credit it, and then cash is debited.
it is also increasing, so you debit it. Okay, so Emily, one rule of thumb, whenever we are talking about the core operations of the business, right? Selling of goods, buying of goods, selling of goods can also be, I don't think they will ever be referred to in the AS level as inventory, sold inventory, but they can be. So inventory, goods, all of this stuff, uh, whenever you're selling it, it is always affecting the sales account. And whenever you're buying it from your suppliers, it will always affect the purchases account. All right. Whenever we're talking about goods, so we're talking about inventory. So it's a good thing. You're absolutely right. As we're selling goods, the sales account is affected. Sales is an income. Whenever income increase, we credit. And as we're selling in cash, our cash is increasing, which is an asset. So we will debit it. Hence, cash will be debited by 3,000 pounds. and sales will be credited by £3,000. And the sales may also be referred as revenue. So don't get confused. Both of these mean the same thing. And let's do purchases as well.
Sir, does sales account follow like expenses or does it follow income?
The sales account will always fall in an income account because the cash is coming in, right? Either the cash is coming in right now or you will receive the cash. If you do the sales on credit, you will receive the cash later on. But the main activity which has happened in order for you to get the cash now or in the future is basically an income activity. You made a sale, you received an income.
Okay.
All right. So purchase goods for £500 in cash. Okay, what would be the entry here?
You debit a purchase account for one. Is that for 100?
It's 500, yeah.
Oh, okay, 500, and then you credit cash for 500.
Absolutely right. Credit cash for £500. Perfect, perfect. So we're good with this. Now let's do a separate kind of entry, which is okay, invested pound 50,000. Invested 50,000 into the business bank account. How would we record this, Emily? Any thoughts?
It'll be capital and bank. So I think capital increases, so it'll be credited, and bank will be debited with 50,000.
Absolutely, perfectly said. Capital is increasing, will credit it, and bank is also increasing. So we will debit it. Bank is an asset, capital is obviously capital. Very good. Now the entry, what we would make is bank will go on the debit side and capital will come on the credit side. Absolutely. And let's do an example for drawings as well. So owner took out 500 from the business bank account for personal use. Okay, here Emily, what are we doing here?
So first the bank account's decreasing, so you credit the bank
Okay,
for
perfect.
500, and the drawings increase, so you debit 500.
What will we debit? Which account will we debit?
Drawings.
Drawings, right? Because drawings are increasing. Whenever they increase, we read in that chart that we always write that on the debit side. Drawings account will be debited by 500. Bank account will be credited by 500. So yes, this is absolutely right. Okay. Yeah, Emily, I will send you a question and you can solve it before our class tomorrow. It's a small question, there's 5 or 6 transactions, and you can try doing them. All right.
Okay.
As a task. Also, I'll try to quickly give you some idea about what a T account is, and just keep this in mind for tomorrow. We'll practice T accounts tomorrow. All right.
Okay.
So T accounts are also called ledgers. Okay, so there is no difference. Never get confused by this. If they've written ledger, if they've written T accounts, they mean the same thing. T account, as the name suggests, is an account in the form of T. We always have an idea that the left side will be called the debit side and the right side will be called the credit side. In the middle of this account, we always write the account name, whatever it may be. Remember, it will always be the account name. It will never be the category name. Like for example, if the transaction is about vehicle, we are not going to make an asset account. We're going to make a vehicle account. All right.
Yeah.
Okay. So let's say we do make a vehicle account. And I tell you that, okay, so this is the credit side, this is the debit side, we put the pound sign here, pound sign here. And I tell you that we bought a vehicle for 10,000 pounds. And I don't want you to record the journal entry. I just want you to show that to me in a T account. So vehicle, the way your mind should think about this problem is that vehicle is an asset. I just bought a new vehicle, which means my assets are increasing. Whenever my assets are increasing, we debit it. So we'll just write the amount on the debit side. All right. Once this is done, then you try to figure out, okay, how did I actually buy the vehicle? Did I buy it using cash or did I buy using bank? If you bought it using cash, you just write cash here. If you bought it using bank, you write bank instead. And prior to this, you always write the date of transaction, whatever they may be, January 10th, 2021 or whatever.
Okay.
Does this make sense?
Yes, sir.
Okay,
If you
good.
buy it on credit, what do you write?
Sorry?
If you buy the vehicle on credit, what do you write?
Okay, that's a very good question. So I was thinking about getting into this tomorrow, but I can give you a very quick idea. So the entry for that would be, you will again write it on the debit side, for example, 20 grand, but the accounts payable will always be used whenever we're talking about inventory. For example, whenever we're talking about inventory, we always use the sales account when we're selling, the purchases account when we're buying, and when we're doing the buying from our suppliers on credit, we use the accounts payable. So whenever anything other than inventory is being bought on credit, we never ever even touch the accounts payable account. So that is one thing, always remember that. So what we can instead do is, we can make up another account. That account may be called, for example, we can say the name of the creditor, whatever the name of the creditor may be. For example, it was XYZ Corp, right? So we can credit this, and that would suggest that we bought it on credit. Or we can even make an account called bought on credit. Doesn't matter. But usually, first of all, you will never get this sort of an entry to make in the exam. If you do, you will 95 to 99% of the times be given the account to credit. They will tell you that we record credit non-current asset purchases in this account, so kindly record it in this account. So you will just credit that particular account. I've never come across this sort of question in the AS level, but in the university level, you might come across it. If you don't have any account given and the sale is, and the purchase is on credit, so in that case, what you will do is you will make up an account like bought on credit, or you can call it vehicle credit, whatever, right? You can give it a name, and before you're doing the question, you make up a star at the top and you write assuming, or not, don't write assuming, creating uh, this vehicle credit account as the vehicle is bought on credit. So this is what you can do, but I don't think you will ever come across this. But if you do, this is what you do.
Okay.
All right. Emily, any confusions regarding what we did today?
No.
Any questions?
No, I don't think so.
All right, great. I would suggest just revise all of this again, all of your notes, and try to read chapter number, I think it's 2. I'll just share it with you in like a couple of hours. The question as well as what I would expect you to read. It won't take much of your time. And obviously in that reading, there will be stuff that you won't know. We will cover it tomorrow in future classes, but you'll get some sort of an idea of what to expect.
Okay, sir.
Okay. Great, Emily. Thank you for being here. Bye bye.
Thank you. Bye, sir.